G'day, ladies and gentlemen, and welcome to another episode of the Expat Mortgage podcast. As always, I'm joined with my co-host, Jeremy Harper. Good morning, mate. How are you?
Morning, James. Very well, thank you. A little bit.
So what?
I feel fine. I just sound like I'm probably being beaten up a bit this morning. It's just the flu from the kids this time of year.
Yeah,
Nothing unusual.
you sound a bit dusty, a bit blocked up, but that's okay. We will persist on a really important topic today. We've all seen and we've all heard and we've all been listening to all the updates coming out of the post 2026, 2027 federal budget and the
Yep.
measures and the extreme tax reform that we saw from that. We've talked about it on previous episodes, both on this podcast and other podcasts, and we've been guests on other podcasts as well. Today, we wanted to look at, I guess, just a practical action plan for property owners and investors. Especially if we're lumping them into sort of probably three groups along the expat journey, just before you go. So that sort of that pre-departure time frame when you're overseas, and maybe you're planning to invest in property. And then if you're already overseas, you've got an existing property, what that looks like, and maybe also when you're returning as well. Just because I think the budget's leaving a lot of doubt until we see the draft of legislation and we see the kind of momentum that it's getting. But I think what we're seeing online and the general consensus is that, the Australian public is angry.
Mm,
Yeah.
definitely. Yep.
Yeah.
Definitely. Definitely come across for a lot of people as a massive surprise. Very clear now that the dust is starting to settle on this, what they're trying to achieve. You
Mm,
know, for example, with some of those capital gains changes, they were clearly trying to target the retirees, and they went at them again. And they did that in 2019 with some of those changes they took to the election. And of course, by being so focused on that, they didn't realize that, on the back end, they're going to impact a lot of younger taxpayers out there. And they just clearly had no idea of the impact. I saw some Chalmers was on a podcast and he was quoting some stats around how many people he thought under 35 had shares, and like his numbers were just
way
completely
off.
inaccurate. Yeah, I think he was saying like 1 in 10 and it's closer to, 1 in 5. And I actually
Yep.
probably think it'd be much higher than
More.
that.
Yeah, well, I mean, I think about a lot of investors that, especially younger generations, they invest in shares, ETFs, these robo-advisors each week, each month from their paycheck to grow savings and a deposit. And then, their goal at some point is either to sell down that asset and then put it into either investment property and do some rent vesting, or build up to a point where they can actually buy and afford a main residence as a deposit. So these changes just hit everyone. They're not just hitting the property market, especially with the CGT reform that they've proposed. I think originally we thought it was just going to be focused pre-budget on housing, residential assets, residential investment properties, all those sort of things. But it's all CGT assets, all investments, ETF shares, managed funds, LICs, anything you trade on an exchange, plus property. Commercial remained unscathed and industrials, but definitely honing in on the residential property. I don't know how this fixes the housing crisis or because obviously it's a supply issue at the moment. Affordability can't just get fixed by this. It's supply.
Yep.
Supply needs to catch up, and they really need to focus on the building construction industry, probably removing a lot of the red tape, speeding up approvals, maybe incentives for that industry as well, concessions to build faster. They did put forward a number of proposals to work with local state governments for building more houses, 50,000 here, and they're going to be built in the next 5 years or something along those lines. So we'll have to see if that actually gets done because they've done that before, but no houses have been built. So
Yep.
it could all just be for votes, but the general consensus is that the Australian public is angry. They're disappointed. They've missed the mark. They've created a divide between older generations and younger generations. I think, if we're drawing it and looking at four dates to lock in after the budget. The main four dates that we can probably obviously take away based on what was announced on budget night. First and foremost, the 12th of May, 2026, 7:30 p.m. So Australian Eastern Standard Time. It's when the grandfathering cutoff for negative gearing will apply on any new residential purchases that are existing properties.
Hmm.
1st of July 2027, that's when the new capital gains tax regime plus negative gearing limited to new builds plus pre-CGT assets get caught. 1st of July to 30th of June 1st of July 2027 to 30th of June 2030. That is the 3-year trust restructure rollover window. Now that applies to small businesses that are set up under a trust. So quick example of that, a lot of plumbers, electricians, a lot of those kind of small businesses, landscapers, they often set up their business within a family trust. They
Yep.
invoice out of the family trust, and then they use the ability to split income to themselves and their spouse to reduce their overall income tax. So that restructure allows for them to pretty much pick up business, pick up the assets, maybe restructure into a unit trust or a company. So that's relieving the capital gains tax that would often apply. But any small businesses which actually own CGT assets, so they own an office within the trust, you can't actually pick that up and move that into a company or another structure because they'll get hit with stamp duty. So
Hmm.
they haven't thought about that one and how that's going to
Yep.
impact hardworking Australians. 1 July 2028, that is when the 30% minimum tax on discretionary trust distributions will obviously start commencing and applying. So there's a lot that we need to unpack, but we can't unpack it just yet on the specific tax reform until we see legislation.
Legislation. And you were saying before the podcast, they're already starting to walk back some of these things. We're only a week in, right? So you're saying the testamentary trust, which is being labeled a death tax, is going to get walked away. I think the more and more about the CGT impact on shares, other assets, on businesses, on startups, there's a lot of noise. Before we even get to that consultation period, it just feels like that's going to be reworked in the background in the short term. But as
Yeah.
we said in the previous podcast, it's take a deep breath. This is a long process. I guess my thoughts would be, if we look at Division 296 and that took 3 years to get into be legislated from when it was first announced, there were some cut-off dates that had to be kind of revised because of the bill had lapsed. So I
Yes.
wonder
Yep.
with this, if this gets dragged out so long, which of course it's going to probably pass the next election,
Oh,
will they have
ooh,
to
music to my
revise some
ears.
of these dates? You know,
Oh, absolutely. I think you're spot on. If it and this get pushed out to like a period where we go to another election, because Albanese he can call an election anywhere, I think between now and 2028. Um, Liberals need to get their shit together. The coalition needs to get their shit together. One Nation. I was saying to Jeremy before, I was like, you might see a new coalition forming with the Liberals and, and One Nation, to be honest, because they are gaining momentum. Absolutely.
yeah,
One Nation, we haven't seen One Nation with this kind of power or
no,
voting power before. So it just goes to show that Australians are fed up. Labor's missed the mark. We'll see what happens over the next 12 months if there's any more by-elections and seat changing. But yeah, certainly an interesting one. I think a lot of economists just think this is going to wash through. It's not going to get legislated, get knocked back, maybe some small tweaks. Labor might have
yep,
had one thing in there that they really wanted to achieve, but they've coded it as a nasty sandwich and saying, let's put it all in this budget. And if we just get one thing, we'll be happy. So
yeah.
maybe that's what's happening here.
But probably short term, I mean, if we think spring's not that far away, spring's always a big high activity selling market in the property market in Australia.
Yep. Yep.
With this hanging over this sort of cloud, unless you are looking for an owner occupier and you need to transact, this is going to, a lot of people are just going to sit and wait because they don't understand. There's so much uncertainty. So naturally they're going to say, okay, let me just see how this falls. So there's going to present a really, really strong buying opportunity for people that need to buy this
Yep.
year. So
Yep.
fantastic. If you're on the sidelines and if you've got the borrowing capacity, this is the time. And then on the other side, just have to be really careful. There's going to be a lot of people come into the market. They're going to start flogging off the plan apartments because they'll say,
Yeah.
hey, we're,
Yeah.
we're custom made for these changes. And I'm going to be saying to anyone that asks me, be very, very careful. Think about what that apartment looks like in a secondary market when you go to resell if these rules to go through. Look at the Docklands in Melbourne as an example,
Yeah.
negative growth over the last 10 years. So if you're buying into the Docklands today, what does that look like in the future? So be very, very careful because if we don't have the negative gearing, then you have to think about what you need to do with that property if you try and upgrade in the future. So it will
Yeah.
change people's, and I think people, first home buyers might start to look at stretching themselves for that family home, even maybe pre-family. So getting
Mm,
that larger mortgage, really stretch themselves, but they go, okay, this is going to suit our needs maybe in 5 years' time, and buying that now, I
mm.
think would be quite a smart play.
Yeah. Yeah, I think you're right on. Yeah, I mean, you covered a lot then, to be honest. But the flogging off the plan property, I think that's what concerns me for
Oh yeah.
our clients, just getting caught in some very clever marketing funnel and, selling the whole negative gearing dream, which, getting your tax refunds, positively geared property through, tax refunds and all this crap, and they're flogging stuff that's out in a mining district, which just won't do anything. I've even got clients that have been caught by it, 10, 15 years ago. So those properties are still underwater, and like we
Yep.
can't sell them until, we get a little bit more capital growth. So we at least break even, clear the debt, and off we go, rather than having to cross collateralize the debt on a main residence or anything like that. It does happen and we see it. So that is definitely my concern, for the clients, that they might get caught in some of those webs. So hopefully, hopefully that just doesn't happen and these legislation proposals just don't get through. I
Yep.
mean, let's consider an action checklist before
Yep.
an expat's leaving to head overseas. Let's run through it. Let's think about, first one I can think about, if they already own, say, investment assets, share assets, is this what's called deemed disposal. So
Yes.
um, deemed disposal is also like an exit tax that Australia has. So if you own shares, ETFs, managed funds, and you're heading overseas becoming a non-resident, when you're a non-resident, typically those assets are actually tax-free. They're non-taxable Australian property. So if you know that you're going to be overseas and this is a permanent move, opting into deemed disposal could make a lot of sense. You pay the tax on exit, but then that portfolio can now grow completely tax-free for the time that you're overseas. So that's something that needs to be considered as part of your pre-departure lodgement, when you're obviously heading overseas on that tax return. What about property, if they own property?
Yeah, getting a valuation done, engaging a valuer just to get an understanding around your cost base for, if you got a current property you're living in, or if you've got an investment property on your departure date. Would you recommend, if they've got property held in a company that's not in their personal name, would you also recommend getting a valuation done, or is that not necessarily as important?
It's not really relevant. If the company can keep operating as a resident company, market valuation isn't necessary because it's sort of in its own environment, in its own
Yep.
bubble. Your non-residency isn't linked to that property segregation or anything like that. It's just all treated still like the company's an ordinary Australian resident. So no, don't need a valuation if they're in a company.
Yeah. And then just understanding your main residence exemption, which is your 6 years, which is available
Yep.
for tax residents. So what
Yep.
what are you going to do around that exemption? How are you going to utilize that whilst you're abroad, or what are your plans? So it's really, I guess, thinking about selling before you leave, or holding on to that asset whilst you're an expat.
Yep. Yeah, absolutely. Like we've got clients that have used up the 6 year rule and then they think they're heading back a year or two later. So to further prevent any further taxation on that, they actually just kick out the tenants, and don't rent it out past the 6 years and leave it vacant. That way they've used the 6 years, they come back, they move into it for a year or two, and then usually we find that they might upgrade the property into something larger. So they've built up the capital gains, they sell it as an Aussie tax resident, it's then tax-free. Um, just remember the budget measures that were announced recently, they're not touching the main residence exemption. So that
Yep.
still becomes an important tool to either build wealth or maintain sort of that tax-free asset. So that's a good one. What about before leaving on the finance
Yeah,
side?
just getting a little a finance health check. So looking at your borrowing capacity whilst you're a tax resident, is there anything you need to do? Do we need to look at some sort of accessing some leverage to have there into the future? At the moment, for people that have established property, there's probably a fair bit of equity there they could look at. And then what does your borrowing capacity look like when you become a non-tax resident, let's say in 6, 12 months time, with your overseas income and outgoings? I mean, it won't be exact, but we could sort of do some modeling around that to say, okay, this is what your borrowing capacity looks like then. And is there a material difference? And that may dictate like what we do at that point. But just be mindful that there can be a restriction on lenders whilst you're abroad, and some lenders will restrict the terms. So, some banks are not as comfortable with interest only whilst you're overseas. So maybe that's something you want to sort out as a tax resident before we leave. So yeah, just getting that done, give yourself a bit of time, maybe a good 6 months out, just to sort of go through those numbers. And then the
Yep.
final one is more just if you've got
Structures.
assets in a trust or a company, just change your accountant about that.
Yep.
Again, like even if these changes go through on the trust, it's probably not going to make a material difference to do anything. It's just going to end up costing you more, particularly if you move assets outside of an entity. The stamp duty, as you said, which is very expensive, and that's going to eat into any potential tax savings.
Yeah, that's right. If you're owning in structures, like if you own any assets in a company, just remember you can't tap into the current CGT discount concessions anyway. So nothing's changing there for you. Trust, obviously, it is changing, plus that minimum trust tax as well. Um, but yeah, I mean, it's just an issue. And we really need to see the draft legislation. It's hard to provide too much commentary, but these are certainly some good things to do as part of a bit of a checklist before you leave.
Yep.
What about as we move overseas? Uh, Running through like a checklist when you're actually overseas, you're either planning to buy or you already own back in Australia.
Yep. So maybe we'll start with sort of you're looking to buy property. So just some things to think about, making sure you've confirmed your tax residency with your accountant. That's always important.
Yep.
And then we get an updated borrowing capacity. So now we know your income currency, where you're living, what's the terms of your engagement with your employment, how is that structured? Is there a big annual bonus as part of your package that maybe we need to wait for that to come through? Sometimes people may a lot of bonuses get paid, say March. So that might be a good time to think about, okay, now I'll get a new updated borrowing capacity done to work out what our options are. And then just thinking about, so with the budget changes, obviously if it all goes through as it stands, there's going to be a different treatment towards this buying an established versus a new build. So just
Mm.
keep in mind that,
Yep.
if you confirm that you're a non-tax resident, doesn't really impact you, right? Because if you're making a tax loss on a new build or an established, as a non-tax resident, it's going to get carried forward either way.
Yep.
So
Yeah.
I certainly wouldn't be trying to pick a quality asset based on a tax strategy because it's really not applicable here at all around the negative gearing.
No. No. No, it's not. And I mean, I was surprised there wasn't too much in there about FIRBs, the Foreign Investment Review Board. There was obviously those larger assets purchases when it's over 20 mil, but the FIRB status was remained unchanged. So
Yep.
I think if you're overseas, you're considering to buy, or you already own, but mainly if you're considering to buy back in Australia and you're buying with a permanent resident, like your spouse
Yep.
is a permanent resident or a foreign citizen, no sort of visa status, just make sure you do your due diligence and check the kind of stamp duty that you could
Yep.
inherit because we see that as a bit of a silent one that does catch you out. But then also the land tax surcharge going forward.
Yep. Yeah. Correct. Correct. That's right. Just trying to, yeah, get some advice on that because once you've settled, then it's very hard to unwind that. And
Yep.
then finally, just, opening, make sure you've got an Australian bank account for property purchases. A lot of the time we can get that set up as part of the application. So that's relatively straightforward, doing it at the same time. And that just makes it a little bit easier because it can be hard to apply for a bank account in Australia in isolation. So doing that as part of the package. And then
Mhm.
if you need some boots on the ground assistance, making sure you're speaking to a buyer's agent that's local that can help you out with sort of sourcing that property.
Yep. Yeah, absolutely. And what about talking about probably stage three, the
Yep.
last part of it?
Yep. So we've got a property. Maybe we're just wanting to review it or we want to actually add to our portfolio. So again, ensuring that you understand getting those valuations done at those times. So looking at that 30 June 2027 is really important.
Mm.
Um, making sure you've documented the cost base. That's really important as well. And also if the asset that you held is actually pre 1986, that's something to think about as well. There might be a few
Uh,
expats out there
yeah,
that
80 or 85 September, but yeah,
so
86.
'85.
The that was actually a question we had on the webinar earlier this week. So if you join us on the webinar, thanks for coming in and obviously throwing up some questions. But pre-CGT assets, the question that we had around that was a lady inherited a pre-CGT asset in 2018, which was just a residential property,
Yeah.
and then had it moved into it as a main residence, and then was either going to sell it in a couple of years, or move into it and then sell it. And because whenever you inherit a pre-CGT asset, usually if you're inheriting it now, your cost base essentially forms when you inherit it, because it's like that's the acquisition date, and then after that, that's when capital gains will accrue on it, and then that's taxable. But the question was around the main residence and how that applies. But because she hadn't moved into the asset when she inherited it, and was just treated as an ordinary investment property. It had been left vacant, but it was just an investment property accruing capital gains. But holding costs obviously go into the cost base element in there. But it was an interesting one. Yeah, it was really,
Yeah.
really interesting one. What about
Yeah.
refinancing?
Yeah, again, looking to a bit of a finance health check on that. I
Yep.
think the thing to think about is just that leverage strategy. So that's still very much in play. And I
Yep.
think for expats that do have some property that you see on some equity, and if there's serviceability, or even, there's other products coming to the market now where, you know, it's quite creative how some banks have got products where they can go, second registered mortgage if there's serviceability issues to kind of release further equity. But I think
Mm.
having that sort of leverage play is going to be more and more important. Perhaps
Yeah.
if an expat's thinking, well, with all these changes and interest rates going up, maybe I need to sell a property from a cash flow point of view. Is it an idea maybe to access some equity to kind of tie you over that period? So that's some things to think about. And then finally, just again, speaking to your accountant around sort of any investments that you've got held in a trust in Australia whilst you're abroad.
Yeah, the trust one's an interesting one because it's like if depending on the type of trust, because I can see fixed trust or hybrid trust becoming more important. And that's something that our managing director Ben talked about, how through this new kind of legislation, you might actually see some new kind of vehicles being created off the back of it. People using unit trusts with companies as a bucket company. But or the other thing would be maybe using like a hybrid trust to a degree, or using investment companies, a company, and then shareholders. So yeah, it's going to be interesting to see what forms off the back of this. If we head on over to probably what would be some questions that we've got
Yep.
from our Facebook group, I think that's
Yep.
probably a good next step.
Yep.
I might read this out to you, Jeremy, because these are all quite finance heavy. If there's anything tax related, I'll jump in. Let's jump into question one. David, departing for Singapore later this year, just after June this year. I'm leaving for Singapore in September. I own my Bondi home and one in Newton, an investment unit. What's the single most important thing to do before I get on the plane? Well, good question.
Very good question. I mean, so getting valuations done through a registered valuer for both properties, that will cost you a couple $100,
Yep.
and because that's going to form the base for your CGT calculation into the
Yeah,
future.
well,
So
yep.
again, it depends on how long you've been in Singapore, etc. But you've got the main resident exemption that you need a portion, and you've got the six rules. And now we'll just need to understand the cost base in 2027. If these rules go through, just understand around that adjusted cost base in the future. So yeah, that's probably the most important thing.
Yep. Yeah, I agree. Couldn't add too much more to that, to be honest. Another question here from Priya in Dubai. Looking at Brisbane, I think Brisbane's a good market at the moment. Southeast Queensland, I think, is a good market. It's the clear sunny coast where all the oldies go and retire. I'm in Dubai earning dirhams. I've been pre-approved for a Brisbane investment property. Great. Should I rush to settle before 1 July 2027, or does the build type matter more? So good question. I'm happy to take this one.
Yeah.
Um, it really just depends on probably the goals, Priya, of what you're trying to achieve here. Remember, if you're overseas, you're a non-resident, regardless of the asset, you don't get the negative gearing benefits. You get the ability to accumulate your income losses until you return back to Australia and then use them. If it's a new off-the-plan build, you know that you'll get the negative gearing benefits when you come back to Australia because that's in the legislation. If it's a case where it's a pre-existing build, the losses will just accumulate against the asset itself. And then once that asset turns into being positively geared, it'll start to wind down. And then you can also use the losses to offset any future capital gains that you might realize from the asset when you sell it. So there's not really a clean way to say what matters most. It really just depends on your individual circumstances and what your long-term goals are. I think if you're buying where it might be an owner-occupier, You might prefer something that's off the plan, clean and new, and no one's really lived in it. It's not going to have too much wear and tear by the time you come back. If you want sort of a house or one side of a duplex, you're very likely going to be buying something that's pre-existing, something that gives you a bit more space and room in a backyard or anything like that.
Yeah.
Um, and often I find that the value and the capital growth is in the land and the location, not necessarily the apartment, because it's very easy to throw up another apartment building in a lot of capital cities. So I'm a big believer in buying one side of a duplex or a house that's sort of within 20 minutes of a capital city if you can get nearer to it. Resale market, especially probably in off-the-plan properties or units in the future after this legislation might be a little bit soft
Yep.
compared to existing assets. So I think that probably warrants a bit of a catch-up call, Priya, if you need it. But it just depends on the goals. Either way, you're doing the right thing. Big believer in property as a wealth tool as
Yep.
part of the overall asset class
Yeah,
location.
perfect.
Yep.
And we've got one from Michael. So Michael messaged from London. He owns three properties in Melbourne. So in a family discretionary trust. So he's earning pounds. Should I be looking to unwind the trust during the rollover window?
Oh, it's a good question. So the rollover window, it's really important to understand who gets the benefit of this rollover window and this restructure, that 3-year rule.
Yep.
It really only applies to those running a business within the trust where they can pick up the business and the assets and pretty much move it into another entity or structure. If you're just using the discretionary trust as like an investment vehicle to own property, shares, those sort of things, you won't get the rollover relief, unfortunately. It's mainly if you own a business, own businesses, you can use the rollover relief. But the way the wording came out in the budget papers was just focusing on businesses, not investments. So you won't get the rollover relief. We'll have to wait and see the draft legislation. But even so, if you were to pick up these property assets and try and move them out of the trust, you will inherit stamp duty, and in
Yep.
its current form, you'll also inherit capital gains tax. So at the moment, it's hard to say, make any changes and shifts, but at the very minimum, if you were to pick up those assets and move them out, the big trap there would be stamp duty.
Exactly. Exactly. And I guess on the back of that, just on the finance side, if let's say he's got three positively geared properties in Melbourne that are spitting out income end of the year and he's concerned about that. Obviously, going back to what I said earlier, could there be a debt strategy? Could we pull some equity out, get a fourth property? And that can be negatively geared property four, and that sort of washes away the gains or the taxable income on the other three properties within the trust and
Yep.
neutralizes that out. So,
Yep.
um, that's something I'd be thinking about because sometimes people with these changes think that I can't claim it at all. It's not the case. It's just in aggregate. So if an entity's got three properties that there's income, we can go back and get debt out and claim all that on the fourth property and run that at a loss. Maybe have 100% borrowing on that property,
Mm.
and it works out to be quite a tax efficient way.
Yep. Yep. Couldn't agree with that one more. Some good questions there. That's probably a good part there to wind up for today. We really appreciate everyone tuning in. There's going to be a lot coming out from this legislation. I feel like we're going to be talking about the budget measures probably for the
Yep.
next couple of months, to be honest. Again, much like what I said on the webinar and our episode in the previous week, we should start to see tranche one of that draft legislation. They have come forward already and said they're going to put a pause, as Jeremy put it, on the trust legislation till later in the year just because of the stealth death tax in there on the testamentary trusts. So
Yep.
we'll keep an eye on that one. If you are in our Facebook group, great. We'll be putting a lot in there as these pieces come out. If you're not in there, join. There's some great things going on between other Australian expats, everyone helping each other. We just act as the moderator to help and support you guys. We've got some webinars coming up once more as well. So stay tuned. And as always, Jeremy, thanks for your time.
Thanks, James. Thanks, guys.